Hey there. I thought I'd make a quick video to answer two questions that were posed in the Discord app yesterday. So the first question was about diagonal calendar spreads. Specifically, what are they? And so I hope to answer that in this video. And then the second question is, how do you place a trade through the Thinkorswim mobile app, which is the app you're seeing on my screen right now. And so I think I'll be able to answer that at the same time I talk about diagonal calendar spreads. Now you can see on my screen I've got CVS pulled up, and here's the 1 year chart. You can see kind of the range it's been in over the last year. One reason for picking, if you're following my trades yesterday, I propose this diagonal calendar spread on CVS. One reason for picking CVS is, number one, it's undervalued in my opinion. If you look at Morningstar as well, which you can actually access the Morningstar valuations if you have a Robinhood account with the gold status or whatever. You pay $5 a month for that gold service. I think Morningstar values CVS at around, I think, close to $90 a share. And then when I did my own valuation, I was getting in the, I believe it was the mid $80 range. So I do think it's undervalued here, and it does have actually some tailwinds with COVID. They've got a bunch of COVID testing sites that they run and get paid to run those COVID tests, and it doesn't seem like it's dying down anytime soon here in the United States. Anyway, enough about that. So you can see the second reason for picking this trade is, technically speaking, you can see these Bollinger Bands, these red lines here. That's kind of a one standard deviation move. So, if it gets outside of that, that's an odd move. So when it gets kind of down to the bottom Bollinger Band, that can mean it's oversold and maybe will kind of retrace back to the median. And so you can see it recently kind of has come down a bit and is maybe hitting some support around that $62 level. So that was the second reason for putting on this trade, is maybe, it will stabilize and go up from here, which it has the last couple days. Now, so if we go to the options tab, let me tell you what a diagonal calendar spread is. But first, let's just go over the basic spread, the vertical debit call spread, which is kind of the bread and butter trade. But you can think of a diagonal spread as a modification or kind of a special flavor of the debit spread. So let's just go over the traditional spread, and how you would enter that. So I'm in the August expirations, and so those expire in 52 days, these options. Let's say I wanted to buy the 62.50 call. So what I would do with my fingers, I would tap the price in the ask column next to 62.50. So when you're buying, you're going to tap on the ask column. And then let's say I wanted to sell. Let's say we're going to do a $5 wide spread. So I'm going to sell the 67.50 call. So I'm going to tap in the bid column on the 67.50 strike. So you can kind of see how now it's shaded on those two strikes, right? Let me get out my pen here. You can see here and here shaded, right? So then down here, I'm going to click on this button, paper trades. I'm doing paper trading. This is the paper trade account. This button's actually green when you're live trading. So I'm going to click trade spread, right? And then it's going to bring me to this screen, and it will show the price. Let me get my pen out again. Right here and this is at the mid. So you want to look and see, this says mid. That's the midpoint between the bid and ask. You want to go for the midpoint. So you don't want to overpay for these spreads. So usually you'll be able to get hit on your trade at the midpoint between the bid-ask spread, right? Between these spreads here. So you're buying the one, you're selling the other, right? And that's netting out to be $2.54 times 100, because we're talking about options, which are contracts in quantities of 100 shares. So that's really $254, right? When I add my commission in, it's showing me a commission of a little over $1, which actually I get 50 cents commission. So this would only cost me $1 commission. I don't know why paper trading is showing $1.30. So then you would click confirm paper trade down here, and then you would look at it, see if everything looks good. It does tell you your max profit here, right? And let me just go back one screen. So if you scroll down here too, on this previous screen, you can see, and these numbers sometimes are a little wonky, but usually they give you the correct numbers. So, right, we're going to buy it for $254, so that's our max loss. That's the most we can lose. Max profit is $246, right? Because the maximum value that this spread can be, since it's a $5 wide spread, is $500. So 500 minus 254 cost means our max profit is 246. So almost a double, right? Basically a double if the stock is trading above, you can see right here, that's the 67.50 price right there. So if it's trading above 67.50, you make this max profit of 246. If it's trading at 65, roughly, that's your break even, right? And then below that, you're going to lose money. Okay, so then we click confirm, and then we would click send paper order, which is right down here, this button, right? And that's how we would place the trade. Let me just click it. This is what happens on the app. It'll say working right here. But let me go ahead and just cancel this order because we're not really placing it. Okay. So let's go back. Let's see. Go back to CVS. Now let's talk about that calendar, or the diagonal calendar spread we put on yesterday. So we were going to do the same thing. Let's say we wanted to buy the 67.50 August 21st call, right? And then instead of selling an August call at a higher strike, we're going to sell, let me just try to remember what I did exactly for the trade. Yeah, I'm drawing a blank on exactly what I did for the trade. Right, okay, yeah. So now I'm going to sell the July 17th. So you can see up here, July 17th, right? I'm selecting from those options. And I sold the 66, right? So you can see that I tapped in the bid column because I'm selling on the July 17th 66. So when I click paper trade, you'll be able to see that the cost is $3.15 or $315 for this. Oops. Now, your profit loss is kind of a little bit weird. Your profit loss graph is a little weird on diagonal calendar spreads. So, because you have two different expiration dates, right? So the expiration date of the call that you sold, it expires in just a few days on July 17th. So this is showing you the profit loss graph on expiration. This blue line is at expiration on July 17th. You make the most money at Sorry, I had a notification come in, so I had to stop the video for a second. So let me see if I can remember where we are. So with diagonal spreads, what you're basically doing is you are selling a front month option, meaning an option that expires closer in time to right now. So in this case, we are selling the July 17th option for $120, roughly, right? And then we're using that credit we're taking in for selling that option to help finance or pay for this longer term August option for roughly $400. Sorry, ignore my notifications. And then, so effectively we are getting, if this July option expires worthless, then we're getting the August option for a price of about $300 instead of $400, right? And so with diagonal spreads, you're kind of wanting the stock to appreciate a little bit. So we want it to kind of come close to the $66 because that's the strike that we sold, but we don't really want it to go exceed that $66. And so we still don't want the stock to go down because we're going to lose more on this 6250 call than we will gain on the 66 call if the stock goes down. So we're just kind of hoping in the short run, right? I think we have about 12 trading days between now and when this July 17th call expires. So we're hoping that the stock just doesn't move a ton up. Now, even if it did, it's still not bad for us. We'll still make a profit. It's just the higher the stock goes above $66. If you look back at this graph down here, you can see kind of the slope here. As it goes up and up, our profits just get smaller and smaller. But you can kind of see like it never goes, our profits never disappear really completely. But they just start trending towards zero. So we'll still be in the positive range if the stock rockets up, right? But our max profit is if at the July 17th expiration, the stock is trading at 66. So these are psychologically favorable trades because you kind of want the stock to not perform great. And so if the stock kind of goes down a little bit or trends up very slowly, you're actually happy because that's actually causing you to gain on this call here that you sold, right? You want that to expire worthless. And then after July 17th, that's when you want the stock to rocket up, when you're left with just this 6250 call. Or another thing you can do after this July option expires, and let's say it expires worthless, you could sell another call. Maybe you sell, let's just go back to this screen. So maybe you sell the July 24th, one of those options that hasn't expired yet, or the August 7th, or you could just turn it into a vertical debit spread and then sell, maybe the 6750 call at that time and collect even more credit and reduce your cost basis on that 6250 call, right? So there's a lot of options, no pun intended, of what you can do with diagonal spreads and kind of adjusting your position as you go along. It all just kind of depends on where you think the stock is going to ultimately go. So I hope that I've answered both of those questions. If you have further questions, please ask them on the Discord.